welcome to Economic Chat. Let's Talk Business with Mr. Daniel Steinman. I'm Elsa Bitimiani, your hostess, and today we are talking about interest rates. So welcome, Mr. Steinman.
Thank you, Elsa B. And good evening, good afternoon to all our listeners.
Good morning as well. Okay, so the Monetary Policy Committee has decided to increase the repo rate to 6.75% to continue safeguarding the peg between the Namibian dollar and the South African rand. The decision was guided by a comprehensive assessment of the latest economic indicators.
Elsa, you realize that's all nonsense.
Uh-huh.
It's what economists call fluff.
Okay, you say it.
It sounds nice. It sounds very impressive and very learned. But it is not what interest rates are all about.
Okay.
What is very important is on the 29th of April, the Reserve Bank, they also have a monetary policy committee, same as we do. They raised the repo rate in South Africa by half a percentage point, 0.5. So they are now on 7% repo rate, and we this week raised it 0.25 or a quarter percentage point, and we are now on 6.75. So there's this small differential of 0.25 of a percentage point between us and them. So the interest rate in South Africa is slightly higher than in Namibia. Now, you can't go and adjust interest rates by a full percentage point, by 1%, for instance. The shock to the economy is too big. So typically, if you are in the region of a repo rate below 7.5%, you make adjustments in a quarter percentage point increments, 0.25, which is exactly what we did and which is also what I expected. The fact that the South African Reserve Bank raised their interest rate a month and a half ago by half a percentage point, 0.5%, indicates a fairly significant adjustment. You know, it's double what we would have expected. But for us, the whole thing about interest rates, this nonsense about maintaining the currency peg and you know, our currency in circulation is 2.8%, at the most sometimes 2.9% of the total rand in circulation. It really doesn't make a difference. You know, we are allowed to peg the Namibia dollar to the South African rand because of the common monetary area. And that's in a bilateral agreement that we have. And nothing that the Bank of Namibia does or will do will change that thing. That thing will only change on a political level. You know, not on a banking management level. So I don't say it lightly when I say it's absolute nonsense. And anybody with 2 brain cells and a degree in economics know it is nonsense. But the difference is important, because what happens, and this is typically, if you look back 30 years when we were looking at interest rates, repo rates, in the region somewhere between 18 and 21%. Now, did you hear what I just said? Can you? I mean, there are people alive and they are working and they don't realize before they were born or at the time that they were born, interest rates were close to 20%. It's 3 times higher than what it is now. So what happened then is that the capital market in Namibia was in its infancy. It wasn't very developed. There was no depth, and if there was the slightest differential between interest rates here and interest rates in Pretoria, the institutional investors would take their money, their long-term investments, to the South African capital market. So they would buy South African government bonds instead of Namibian government bonds. And the only way that we could counter that was to have a repo rate. At that time it was called a bank rate, of about half a percentage point, 0.5, to 3/4 of a percentage point, 0.75, higher than the bank rate in South Africa, so that we could attract those investments to the local capital market. And this was slightly longer term. This was from a year to about 10 years. I didn't think at that time we had any instruments exceeding, I'm talking about government bonds, exceeding 12 years. It was only later that we started introducing the longer dated instruments. But the whole point was that we had to keep the interest rate higher in Namibia than in South Africa to ensure local liquidity, so that the institutional investors would invest their money here, because the return is bigger. You know, if the interest rate in South Africa, or the bank rate, was 18%, and here it was 18.75 or 19%, then it's obvious that they would go where the return on the investment is the highest. But that often created liquidity problems in the banking system. Now, it wasn't really a big problem then, because all the banks belonged to South African companies. But we can come back to that, because that created some very scary situations in the local market at times. Not always, but at times.
Let's quickly go for that short break.